Hi, welcome to this first class in accounting. Let's make it interesting. First, let's understand why study accounting. Accounting helps in understanding how much cash we have invested in business, what assets we have purchased for the business, how much raw materials we have purchased in a certain period, how much we have spent towards various expenses in a specific period, what revenues we have received in a particular period, how much money we owe to outsiders, how much money we should get from our customers, what were the cash inflows and outflows during this accounting period, how much profit we have received in a year, how much profit we have distributed to shareholders, etc. What is accounting? Though there is no unanimity among accountants as to the precise definition, the most acceptable one is the definition given by Association of International Certified Professional Accountants Committee on Accounting Terminology. According to the committee, accounting is the art of recording, classifying and summarizing in a significant manner, and in the terms of money, transactions and events which are in part at least of a financial character and interpreting the results thereof. So, as per this definition, accounting is art, it is not a science. In specific, it is an art of recording, classifying, and summarizing various transactions which are of financial nature to help us all in interpret the financial position of a company in same way at the end of the accounting period. Now, let us move further and understand how we should record the business transactions in accounting books. Over a period, two accounting systems evolved. First, single entry bookkeeping system came in where the business people started maintaining cash account to understand how much cash they received and how much cash paid to other for different reasons apart from maintaining personal accounts to understand how much they need to collect from others and how much money they need to pay to others. Other than these accounts, they never maintained any other account. They never recorded any transactions related to assets, expenses, losses, incomes, and gains. But, over a period, single entry bookkeeping system became obsolete because of its limitations, and double entry bookkeeping system came into existence. Let's understand this concept closely through an example. In any trading or manufacturing organization, we purchase raw material or goods and sell them. We purchase on cash or we purchase from some other party on credit. Sell goods on cash or sell to others on credit. We make payments to others or we receive payments from others. We pay wages, we pay salaries, we pay rent, and we pay taxes, etc. In all these transactions, one need to understand that typically there is one giving aspect and one receiving aspect. For example, when we are buying raw material on cash, we are receiving raw material and paying cash. If we are buying raw material on credit, we are receiving raw material and giving a commitment to pay other party at a later time. Thus, we can understand that there are two aspects for each transaction: a giving aspect, another a receiving aspect. This dual aspect has brought in double entry booking system where for each transaction, two entries are made. One forming a debit entry in one or more accounts, and another forming a credit entry in one or more accounts. This double entry bookkeeping system is based on dual aspect concept. In every business, we have various transactions. In simple, every debit has corresponding credit, and every credit has corresponding debit with equal amount. This principle is applied to ensure satisfaction of the accounting equation equity plus liabilities is equal to assets. Now we need to understand the most important idea: debit and credit, the prime theme behind double entry bookkeeping system. In simple, debit is left-hand side of the account and credit is right-hand side of account. Then what is account? Account is a summary statement which tracks the financial activities of a specific person, asset, expense, loss, revenue or gain, and it gives summary picture of the same for an accounting period. An account looks like the letter T, and it has two sides to it: debit side and credit side. Debit side of the account indicates left-hand side of the account, and credit side of the account indicates right-hand side of the account. In addition to this, all the above stated accounts are classified into three accounts, namely personal accounts, real accounts, and nominal accounts. Personal account deals with individuals. The individuals may be human beings or artificial persons. Basically, the individuals are of three types: persons representing natural persons like Ram's account, Obama account, etc. Artificial persons representing partnership firms, associations, and companies like Rama and Krishna Sons, ABC Industries Limited, and Tata and Sons Limited, etc. Representative persons representing person or group of persons like salary payable account, prepaid expenses account, and outstanding salary account, etc. When it comes to real accounts represent all assets belonging to a business enterprise. Real accounts are divided into tangible real accounts and intangible real accounts. Tangible real accounts include assets that have a physical existence: building account, inventory account, furniture account, investment account, etc. Intangible real accounts include all accounts which does not have any physical existence: trademark account, patent account, goodwill account, copyright account, etc. Nominal account represent expenses, losses, gains, and revenues of a business. The nominal accounts may include wages account, rent account, electricity expenses account, salary account, traveling expenses account, and commission received account, etc.